When evaluating student housing, the first thing you want to look for is the university itself. You want to make sure your economic anchor is stable, that enrollment is consistent year in, year out, decade after decade, without a whole lot of other things impacting it. How has enrollment historically been impacted by economic cycles, by stock market fluctuations, things like that? You want to make sure that the institution itself is stable. So I think that's really the value of student housing, is you're leveraging the historical stability of a major institution, maybe one of the most stable institutions in the country, and you're using it as an investment vehicle that's not impacted by outside forces or that is not correlated to the rest of your portfolio. And focus on universities in particular that consistently draw people year in, year out, regardless of macroeconomic factors. That, I think, is probably the most important. Second, you want to look at the property itself. How did it perform over the Great Recession? Were they able to raise rents? Were they able to stay full? Those are very important too, because part of your strategy with student housing is to find an asset that just doesn't show any correlation to the economy. Whether it's a great economy or a poor economy, you want the stability and the consistency, and that's what you're trying to get with student housing. Another key element is evaluating the competitive set. You want to take typically the 4 or 5 primary competitors and look at their track record over the last several years. You want to make sure that the other properties that you primarily compete with are doing well too. You don't want to be in a market where everybody's throwing off concessions or discounts. You want to be in a market where everybody's doing really well, and in many cases, because they're leasing up faster, it creates demand for you, and you're leasing up faster, and you're actually building each other up, and you're in a market where everyone's consistently filling up, everybody's raising rents and growing income. One of the benefits of universities is that they've been around for centuries, and inherently all the land near campus is built up. There's typically not a lot of land available within walking distance of campus. So if you're able to find a property that's really well located, well positioned, within a couple of blocks from campus, within a 5 to 10 minute walking distance to most of the classrooms, we think that's a gold mine. And that's what's so great about having a fantastic location where students can wake up at 7:53 and still get to class by 8 o'clock, is it's so difficult for new competition to come in and change that or replicate that or take that locational advantage away from you. That's what we like about student housing as well, is we think there are barriers to entry that are inherent with using an institution that's been around for centuries. Another really important element or key factor to success in student housing is really understanding who your target market is. What type of students are you attracting? Is it a growing segment within the student population? And just making sure that overall your property and the types of activities and your marketing is resonating with the types of students you want to attract, the types of students who are going to pay the highest premium for your property. What a lot of people don't know about commercial real estate is the primary valuation tool is what we call the cap rate, which is the net operating income divided by the sales price. So there's a relationship between the income generated by a property and what you ultimately would pay for it. So you want to make sure you evaluate the growth potential of a property, the safety of the income. That's really important from our standpoint, because if you increase the net operating income in the cap rate model, you essentially increase the sales price. One of the best things about student housing that is often overlooked is how low expenses can be. If you picture a property right next to a major university, in many cases, the university itself has fantastic amenities. They'll have a great union building with a lot of different social activities. They'll have a state-of-the-art pool and fitness center. And if you buy a property that's close enough to campus, you really don't have to have any of those amenities to attract students. And in that case, your square footage is almost 100% revenue producing. And in many cases, those amenities are just higher expenses, fixed expenses ongoing that you have to consistently pay for. What that leads to is a really favorable, what we call expense ratio, which is the expenses divided by the revenue. And if you have a really low expense ratio, it means that ongoing your expenses are really low. In some cases, you only have 4 or 5 items. You have your real estate taxes, your common area utilities, and your debt service. And from there, it's really not that significant. Well, that helps in a lot of different ways. First, if you're able to raise rents, that goes straight to the bottom line because there's not a lot of expenses associated with it. Second, if you have an off year, you have lower occupancy or you have some vacancy, because you have such low expenses, your ability to constantly match your debt service or your other expense requirements is really low. And so in many cases, you can have terribly low occupancy, but still cash flow positive. And that makes a property safer and in many cases more stable, because commercial real estate is primarily evaluated based on the net operating income. If you're in a position where you could raise rents, a lot of that revenue growth will fall straight to the bottom line and grow the net operating income. And in many cases, with low expense properties, you can escalate the net operating income at a much faster pace than you can on traditional apartments or other complexes that have really high fixed expenses. So it protects on the downside, but also gives you a little bit more ability to escalate growth in net operating income on the upside if you're able to raise rents.